Happy Monday. Welcome to the Monday Market Update. It's a very festive Christmas week here this Monday. My name is Nash Paradise, here with my good buddy Andrew Cady to deliver all the news that you can use so the loans you do not lose. Andrew, how are you doing this Monday?
Doing amazing. Merry Christmas, everybody. As you can tell, Nash and I woke up extremely festive.
So festive. Ultra. I'm not as festive as you. If I knew it was ugly sweater party day, I would have done differently, but I am still decked out head to toe in red. And I've even got the old, the Christmas Crocs. So, you know, I've as should be expected, I'm rocking it head to toe. So let's get into what's going on here. What we saw last week. Let's talk about rates last week. Gracie, what do you think about interest rates?
Rates are good.
Rates are good. Perfect. So that's really all we need to know. Rates are good.
Rates are good.
We like where they are. The volatility index is something that's a little funny right now, and that we'll break into it based on last week's news. It was middle low movement. It should have been incredibly high, but we'll break that down a little bit more. You know, we started the week in the low sixes. We ended the week in the low mid sixes. Everything's been pretty consistent. Anything you'd add to what we saw last week before we get into what we saw last week?
No, I mean, yeah, you're right. You know, it should have been a extremely volatile week. A lot of really good news that should have helped rates. However, as I said in a text message to Nash this morning, I think the markets are simply too drunk on eggnog to react to actual data right now.
Well, let's talk about what happened in the markets last week, because it's kind of shocking. I would never in a million years would have predicted the amount of movement on great econ data. It was the first really big set of econ data that we've had in how long since we had the government shutdown? Huge stuff here. So I know it's small on the screen. Let me break down a couple of the big things that happened. The biggest and the first was Tuesday. We had non-farm payrolls. Those, previous was 119,000 jobs added. The forecast was only 51,000 jobs added. Small forecasts like that, dicey. There's a good chance to come in over that by 20, 30,000 jobs and, see things move the wrong direction. But what did we do? We came in at negative 105,000. That's huge for the October non-farm payrolls. That should have moved the needle. Retail sales down. The November non-farm payrolls had a 50,000 projection, came in at 64,000. You can say that had an impact, but honestly, looking at a 60-day, 90-day history is a lot more impactful there, because what did that do? Took unemployment from 4.4% to 4.6% month over month November. Like, that unemployment number is huge. How did we not get more movement from that?
It doesn't make sense. And when you actually start to break these reports down, when you, again, talking about the 3-month average, when you look at non-farm payrolls over the last 3 months, and investors they're not stupid to this. You look at the actual data that we lost nearly 1 million full-time jobs and added about 1,020,000 part-time jobs. Like not only is it face value weakness, but it's in-depth weakness. The markets should have reacted. We should see the 10-year treasury, based on the data we saw last week, coupling in the low CPI, we should have seen 10-year treasury under 4%. But no, really no movement.
You look at the last time we were under 4%, when we got down to 3.6 to 3.8. We had better data than this, and like it makes no sense. And so you're thinking, okay, well maybe the markets aren't moving because they're waiting for CPI, they're waiting for inflation data because oh boy, Thursday we finally get some good inflation data, and we've got these estimates and forecasts, 3.1 for the headline, 3.0 for the core. Like surely, if we can come in low, that's going to move the markets the way we want to. 2.6 was the mark on the year-over-year core. Like inflation has dropped from 3% to 2.6% by the core metric, on the headline from 3.1 to 2.7. So we lost basically 40 basis points on each. That absolutely should have tanked Treasury yields, and yet a big old fat nothing burger with cheese. Have you seen anything to explain why no movement on that?
The only thing that it makes any logical explanation, and I don't have the answer because we should be seeing massive market movement, is maybe because it is holiday times, very low trading volume will equate to a lot more volatility. And we may actually start to see markets wake up after the first of the year, but it's actually wild. We should be seeing huge runs on mortgage rates right now. The 10-year Treasury, everything should be way better than it is, but it's just stuck.
Yeah, Treasury yield 4.16. It doesn't make any sense. It's very frustrating. You want to be data dependent and data driven, and then you get the data that you're looking for. And we've had 2 Fed rate cuts, 50 basis points since we had the 10-year yields in the low four, in this 4.15 to 4.20 mark, and we're still there. And the data says that jobs are down and inflation is down. So that means rates need to come down, and yet Treasury yield is still where they are. So frustrating for sure. Could the markets catch up to this data? I don't know. We'll have to see why. What I'd like to think it's end of year lack of liquidity right now. Waiting for the Fed to get aggressive with their quantitative easing and see what those repurchases look like. We'll see. Let's talk about what's going on here this week, because apparently data doesn't matter. So, we'll see how much any of this hits. We do have ADP on Tuesday. It's the weekly figure. So medium as far as impact goes, GDP for Q3 is cool. It's going to be interesting. It's looking like it's going up from a previous 2.6 to 2.9 or 3.8 to 3.2. Funny enough, the prices in the GDP are kind of going inverse of one another. I don't think that's going to move things in any meaningful way, but do you have a different opinion there?
No, I think the ADP will have honestly more impact on markets than we will from GDP. So I think it's going to be a very quiet week. Again, low trading volume means probably stuck through the holidays where we're at. I don't see anything on this chart unless there would be a complete blowout on GDP to the downside that would maybe rock markets. As long as GDP comes in somewhere around estimates, I think ADP is the really only news topic of this week that could potentially move things.
Yeah, I mean, we got jobless claims on Wednesday, but again, this is a lot of seasonally adjusted stuff. So, 223,000 forecast. Could it come in lighter than that? Yeah, continued claims. The markets don't seem to care a whole lot about the jobless numbers and the continued claims lately. They haven't really been moving the needle, but I don't like that that's on a Wednesday right before markets close early for Christmas Eve. Then we have the markets close for Christmas. You see a lot of people taking gains and, cashing out right before a long weekend and a long holiday period. No news or anything going on Friday. And now, is it a federal holiday? Is it not? I mean, it's kind of up in the air as far as how that goes with the day before and after Christmas. That's been fun as it relates to mortgage lending. But yeah, it's got a week that's posed for not catching up. And maybe we're going to have to wait until the first of the year to see that recovery that we'd like to see in the 10-year yields. But we'll go from here. So moving on from here, talking about the Fed funds rate. I do think it's interesting that this moved in reaction to the data, but the Treasury bonds didn't. So we've seen a pretty significant uptick on when do we think we'll get the first rate cut. I was thinking April, and I'm still thinking April, but as we keep moving towards a March cut, I'm interested in your thoughts on here because it feels a little soon with what's been going on, but all our aggregators are showing that the March cut right now is 63% likely. they're usually a pretty good indicator by this point.
Yeah, and I would tend to agree with this. I think if the labor market continues to show the level of weakness we've seen, I mean, if you go back to June all the way through November, the unemployment rate has ticked up 0.1% every single month. Yeah, we didn't get technically October's data, but November went up 0.2%. So we are the unemployment rate rising as consistent as it has. If that trend continues, I would think we would be in for a March rate cut, not necessarily in April. But I think it's at this point, we know the one thing we do know is that the Fed is going to remain data dependent. With them reinstituting quantitative easing, it definitely takes an ease off of them from having to do the rate cut and do it so systematically, because the quantitative easing will ease it. That's what they do. So I would think April, but it's really going to be data dependent. If we continue to see the unemployment rate tick up, I mean, let's follow those numbers. If December's 4.9, January's 5%, February's 5.1, we may see a rate cut in February, like if that trend continues.
Yeah, and I would tend to agree. If we keep trending up, that March meeting is going to be all but certain we see a rate cut then. And looking at the calendar here, you got 128 and then not another meeting until 318. That 128 is too soon. But yeah, you get bad data in January and February. I don't think you even need bad data at this point. If we even start to hold at these higher levels on the unemployment rate and hold on our core inflation metrics, we should not have inflation coming down the way it has and employment going the wrong way and still be at the same lows that we are. Quantitative easing needs to take some pressure off the 10-year yields. And, we just need those purchases of those long-term bonds to start to move the needle. That will drive interest rates down prior to any kind of Fed meeting, but it hasn't taken any effect yet, which is a surprise to most of us who are following this. But like you said, maybe it's just a slightly delayed reaction. We need to get a little more liquidity, get to some first of the year bond buying on the treasury auctions. We'll see. So what does this mean for rates?
We're stuck.
Like my daughter said,
I mean, what's crazy is look at this. I mean, guys, look at this, that first drop that we see before that October 25 line. That's rate cut number 1. Came right back up. Rate cut number 2 came right back up. Rate cut number 3, and it didn't even go back down to where we saw it on the first 2 rate cuts. Now, one thing that I will bring up, probably not even the right chart to bring it up on, but MBS Highway released this morning, and they just dropped the data out of the QCEW data. The QCEW is basically, the buck stops with them on employment data. The BLS, the Bureau of Labor Statistics, releases their jobs, all this stuff, but then the QCEW data revises the BLS. And we know BLS always revises their numbers down. So the QCEW data came out on Friday, and it was actually substantially worse than what we were initially thinking. If we look at the data on this, and I'm going to turn to the side because I'm reading it here, from quarter 2 24 to quarter 2 25. So that 12-month window, Bureau of Labor Statistics initially reported 1.92 million jobs created. That figure was revised down to 1.5. And as of Friday, it has been revised down to 420,000 job creations, which means the BLS overstated by 1.5 million jobs. And that is after the BLS revisions. So you can say, no, like the BLS revises that down. Yeah, this is a 1.5 million overstatement from their revised numbers. So the fact that we aren't seeing the markets move is actually mind-boggling to me right now.
Yeah, you got to wonder if it's because it's Q2 to Q2 or if, the markets know where things are. The fact that we've had 3 rate cuts and no breakthrough, like the resistance here on interest rates, the way that they're holding in this low 6.25 range is very, very surprising. I'd like to think that once you can break past this, then we've got some room to go. It's just like a big old dam being built behind a raging rapids, and it's not going to move. You get interest rates down another 25, 50 basis points. It's not going to move things a whole lot in the real estate sector. It's going to be great, and it's going to help a lot of people. But you got to feel like the market can support it pretty easily right now with all the data that's come out, with the direction everything is moving. This would be normal data dependent activity. which just shows, as much as everyone says we're data dependent, we're not necessarily. I feel like there's a lot of, visibility on Japan and their yen and the way things have been going there. Some of the issues going on with the Euro markets, our own stock markets, have a lot more money moving around in them than the bond markets do. So there's a lot of, reaction to that. We'll see. I'd like to think that everything is pointing to a very favorable first quarter. But if you can't move on the data we've had so far, how are you going to move with anything else? I truly don't know. And it's going to make this an interesting podcast the next few weeks as we go through discussing, are we catching up? Are we starting to make up this ground and this traction that we had before? It's good reason to tune in and see where things are headed. Any final thoughts?
Now, I think it's tough for me because I've studied markets for 10 years in this industry. And normally you can just make sense of it. And I think it's tough for guys like Nash and I because if you're a Stranger Things fan, it feels like we're living in the upside down. It feels like everything that should be happening is not happening, and there's no clear reason why it's not happening. So I agree it's going to be an adventurous next few weeks as we tackle these meetings or these Monday morning updates, because there isn't a lot of things that are happening that should be happening. So follow along as we dive into this as well.
100%. Yeah. Season 5, Stranger Things, absolutely peak. Best season yet. It's good stuff. So if you're not watching that, hop on. But also hop on Monday morning market update weekly in my 9:30 hour here Central Time, 10:30 Eastern, where Andrew Katie is located. Thank you guys so much for tuning in, and we will be back rolling every Monday. Take care.